Hey everybody, it is Jay Madursky, Finance of America. Thanks for hanging out with us here. This is our educational blog, help you guys get more sales, get a little education on different tools that we have and resources that we have. Today, what you're going to learn is about a reverse mortgage. I have Doug Ziegler here, who's the professional for our reverse department, handles everything from start to finish. He's going to answer a few questions that I have, and hopefully some questions, we can get some questions answered for you guys out there. Doug has a background that's pretty extensive. I think he carries every little piece of reverse knowledge that you need to know. I also have Frank here from Viral Marketing. He's going to kind of be our moderator here. He's the gentleman with the headset on, the good-looking one.
Thank you.
So what we're going to do today is, this is more of, we want to give you the education, the tools that you can use to help do another loan, a tool that you can use to use as a purchase. A lot of people don't know that, right? We also want to use this to, help people that, hey, if you're not with Finance of America, you can, come here. We have the products to help you be more successful, be more resourceful. So, with that said, I'm going to introduce Doug here. Doug, welcome, and thanks for joining me here today on our educational blog.
My pleasure. Thanks so much.
So, Doug, real quick, make this easy for me. What's a reverse mortgage?
Sure. So the basic principles of a reverse mortgage are, it's an FHA insured loan that's designed specifically for seniors. So you have to be 62 years of age or older, own your home. And the principles behind this is that we look at items like the home value, the age of the borrower, the interest rate involved in the loan to determine how much money is available for the senior. And this money is made available to them to use at their discretion. Can be used for things like home health care, to pay off existing expenses, to stream monthly income for themselves. And the most unique part about the reverse mortgage is that there's no repayment as long as they live in the home.
So when you say no repayment, are they liable for any type of payment on that property? So I'm I'm eligible for a reverse mortgage. I get the reverse mortgage. Am I responsible or liable for any payment, the taxes, the insurance, or anything like that? Or is that all included as well?
Great question. So of course, they're still responsible for upkeeping the property, the maintenance of the property, paying their obligations like their taxes, the insurance. But again, the reverse is meant to give them access to part of the equity to either eliminate part of their current expenses or to generate more cash flow.
Doug, I got a question. I hear a lot of negativity with the reverse mortgage. Why don't you address that right head on and why that is? And obviously it's different and so on and so forth. Yeah,
not uncommon. So the program's been around for 30 plus years. The original programs were something called equity share, where literally the bank went on the deed to the property. They took ownership. That no longer happens. So FHA has been along for a long time now. Now there's certain safeguards and protections put in place. There's even counseling involved for the seniors. So it's a much different animal. It's really evolved over the years. And we're seeing it just be a godsend for so many people because without it, they couldn't really live or enjoy their retirement.
Do they need any type of income to qualify for this property?
Yes, there is a financial assessment that's done, and it's somewhat simplified from the sense of saying that we do look at a certain residual income and a credit history check to make sure that they can fulfill and continue to pay their obligations.
Now, what's an eligible property? Can you use this reverse on a second home?
No, great question. So it's just as FHA states, it's for primary residences, approved condos. We can do certain manufactured homes, two families. So I mean, there's different options that we can look at to qualify. And I would say for all you forward mortgage loan officers out there, apply your FHA principles to that.
How much equity do you have?
The calculation is an actuarial, so it's based on life expectancy and age. Usually the rule of thumb, as I said, they want to have at least 40% equity. Sometimes they could have less. If you've got a senior in their late 80s or 90s, well, then maybe they only need 25, 30%. So, but as a general rule of thumb, look to about 40% equity.
Okay.
Now you say, what type of programs do they have?
There's 4 different variations of the reverse mortgage. There's an annual adjustable, a monthly adjustable, a fixed rate, and then the jumbo, which is our proprietary product, which it's one of 2 that's offered in the whole country. Most popularly, we do the annual adjustable that has the best safeguards for the senior, provides the most flexibility for payment options to them as well.
And I'm just going to play stupid because I really don't know much about this product myself. I'm not in the mortgage arena. Do you get that money like in a lump sum, or is it paid to you monthly or quarterly? How does the money get back to you to spend out of your equity?
Essentially, what we do is we look at the individual senior, the client, and we tailor the loan around them. So, for instance, if a senior has, let's say, a $40,000 mortgage they're paying off, and they've got 20 grand in credit card debt, but they're also looking for additional monthly income, we could essentially do all of that. We can pay off their mortgage, eliminate that monthly obligation, so that's more cash in their pocket. We can pay off their credit card debt, so they get a partial lump sum, and that also frees up more cash flow because there's no credit card payments now. And then there's still other funds available, either to be accessed through a monthly payment back to themselves, or most commonly, we put that in a line of credit. And that's money that they have access to for future years to come.
And then I'm assuming that when they pass on, the home's just sold and the mortgage is paid off.
Yeah, I say treat the reverse mortgage like a traditional mortgage. When the senior passes away or moves out of the home and sells, this reverse mortgage has to be paid back.
Is there like a life insurance requirement or anything?
Nope.
It doesn't sell?
No, and this is because it's an FHA product, this is a non-recourse loan. So if for some reason interest rates would go really high, homes depreciate, senior lives to be 105 into the home, that means the loan balance could go above the value. The borrower and the estate are protected because there's insurance on this put in place by FHA. So there's
insurance will never go over the value.
Correct. They can never owe, the estate or the borrower can never owe more than the value.
That's a law?
Yes, it's part of the guidelines.
Cool.
Yeah.
That's nice. All right.
So the estate, there's no tax or any type of liability to the estate for repayment.
Correct.
Of that loan.
Correct. Now, in most cases, there's equity left in the home, so the estate will want to, whether it's going through probate or go ahead and sell the home, pay back the reverse balance, and keep the remaining equity. So in most cases, there's still a benefit there left to the heirs.
So, I guess my question would be, I have $100,000. I take out $100,000 reverse mortgage. I live for 20 years. My interest rate is adjusted over however many years, so many times. What's that payoff look like? I mean, what are those fees? Are these borrowers going to get hammered with fees and charges?
That's a great question.
To the payoff?
Yeah, so the initial charges are going to be based on percentages, based on how the loan is being structured. So part of that's kind of what I say a risk rating. It's either a low mortgage insurance premium at 0.5% or up to 2.5% of the home value. Again, these are tiered based on how the loan is being structured. Do they have relatively low liabilities and they need little money at closing? Then they're a low liability. Are they paying off a huge mortgage, so they're taking all or most of the money up front? Then they're going to be charged a higher premium. So those costs are individual to a specific loan. Long-term costs, yeah, it is negative amortization. Because they're not making payments, that interest is accruing. So I say treat it like a 30-year mortgage. When you look at an amortization on a traditional mortgage, you pay for that home, usually 2 times over? Yeah. It doesn't look like that much different on the reverse mortgage. The difference is whether you repay it slowly with a traditional mortgage or you pay it all at once at the very end.
Cool. Well, I think now if you want, we can kind of transition just to how it works internally as far as maybe compensation, how it's sold as a loan officer. What are some of the most commonly asked questions that you think should be answered about that, Doug?
So first thing, as far as compensation, so there's 2 different models on the floor right now for loan officers, and obviously for new loan officers and branches coming in, is you have the full ability to originate yourself, and that's a very simple model because it's a brokered loan. FAM takes 2%, Finance of America takes 2% of the revenue, of the total revenue, and the rest is allocated back to the branch. So these can be large paydays depending on how the loan's being structured. Sure. If it ends up being a referral model where they don't want to take the time to learn the product and just want to simply refer it, then the branch would still make their FHA margin. And Jay, you can speak to this because you're more in tune with the forward mortgage side than I am. And I believe that the loan officer still gets their contract basically.
The loan officer will receive their regular Schedule B compensation on that. So that's pretty good, by the way. I mean, if you know nothing about it and you don't want to learn anything about it, to have the option to refer the loan to Doug and his team, to take it from start to finish, which is probably better to do than have you do it as a loan officer that doesn't know anything about it. That's a nice model, and that's a nice option to have.
And if you are looking to, originate yourself, we have a full support model as far as trainings. We are partnered with our sister company, Finance of America Reverse, one of the largest companies out there doing these programs. So, we have extensive marketing material, training materials, so we can get you up and running really quickly with these if you do want to take on the burden, so to speak, of going through the trainings and learning it. So, and on that note, there is that supplemental marketing information available, for you to go out and attack your networks to generate more business with your financial planners, with your realtors. Jay touched on the Heckman for Purchase plan, which is using a reverse mortgage to buy a home. And no one knows about that. Realtors love to talk about that because it's a huge, not just source for you, but source for them to go out and drive more business.
Got a couple questions for you. Cheryl asks, can this be used on owner-occupied multi-units, 2 to 4 units?
Great question. That's not an easy question to answer. It depends on the square footage of the units, to be very direct. So if it's let's say it's a duplex, for instance, if the larger unit the borrower is living in, then it's eligible as far as square footage.
Okay.
Lords asks, do both spouses have to be 62? Great
question. So that's one of the more recent changes. No, they do not. This gets into a conversation of non-borrowing spouses. So there's certain protections that FHA has put in place over the past few years to protect the younger spouse. In the olden days, the younger spouse will be removed from title and be forced out of the home essentially when the older senior died, because the loan is now due and payable. There's now provisions put in place for this to protect that younger spouse.
Got it. I'm just managing the live chat. Feel free to ask any questions if you want. So let's see here. So we promised to talk about basic product information, which we did. Borrower qualifications. Is there anything there we left out on borrower qualifications?
We talked about age, obviously their equity position. They have to live in the property. As we touched on, they have to maintain the property, pay their taxes, pay their insurance. And there's obviously the financial assessment portion.
And then
Doug, can you use, I'm sorry, Frank, can you use what can you use a reverse mortgage for? Say, a lot of us forward salespeople will go out and we'll have a borrower that may be of this age and they have some type of tax lien or some type of any type of lien that they need to pay off. Can you use a reverse for that? Something that's affecting your credit in a negative way. Can you use a reverse to take care of that, or are we going to go off of a FICO score?
No, it's not going off of a FICO. So to be clear, anything secured against the individual or the property has to be settled. We consider that a mandatory obligation. So a tax lien, an open mortgage, open collections, if they're on title, those things would all have to be settled from the reverse mortgage. So that can get into motivating factors on why people look to this to pay off those tax liens. As I mentioned earlier, paying off a mortgage, credit cards, funding in-home health care. What we're seeing more now is the financial strategy and networking with our financial planners to show the ability to leverage the equity, the dead asset, the home, and preserve the retirement accounts. I mean, we're dealing with more seniors now that have $500,000, $1 million in the bank than the ones that can't pay the real estate taxes. So the model has really shifted to more the affluent based on these changes that FHA has made over the past year or two.
Can you use the reverse mortgage to pay? How about foreclosure? If a borrower is going into foreclosure, can you pay off that?
You can if it's going to foreclosure. There's going to be implementations of what we call it's an escrow account for taxes and insurance. So the numbers would have to work. I'll say it that way. There'd have to be enough equity there to pay off the foreclosure amount and still set up an escrow for taxes and insurance.
So you touched on a really great point, which I think a lot of our guys, a lot of our salespeople is another road or another avenue to go towards, and that's the financial planner, where they're sitting with, the mom and dad, or mom has to go into, a nursing home, and that cost is $10,000, $20,000 a month, and the children are liable for that. To do a reverse, are you able to do that, or they're going to have to live in the home, correct?
They'd have to live in the home. So, again, we're seeing it more traditionally. We're seeing seniors not wanting to move to that care facility. They want to provide in-home care. Usually what I have clients say to me is, only way I'm leaving this house is feet first. So, with that being said, most of them, this is supposed to be a long-term sustainable product. To do this, if they're thinking about downsizing or moving in the next year or two, this is probably not the appropriate solution. But the idea is to provide a sustainable solution to keep them there 5, 10, 20 years, or as long as they're able to.
Cool. We got some more questions. This is great. Thanks for answering the questions, guys. James McCarthy asks, what about mortgage interest for income tax since interest is accumulating?
Great question. So because there's no repayment being made, there's no tax write-off at this time. Now, eventually the estate or whoever's selling the property, when all that interest is repaid, that is a write-off at that time, just not currently. It does touch on an interesting point, though, as far as payments. There's no repayment or prepayment required, but the borrower can make repayment at any point without penalty. So I've had people, again, as a strategy, they have some extra money, they apply a payment back towards the interest. If they do make a payment, then yes, they can write it off.
Cool. Cheryl asks, can you explain how you can purchase using a reverse? Is it based on current market value? Is there a down payment? Unclear how to use this for a purchase.
Sure. So I'm going to give you just a very simple scenario parameters. So you have a 62-year-old senior that wants to buy a $200,000 home. They were essentially going to need to put about 50% down out of pocket. The other 50% will come from the reverse mortgage. Now they own this home with a mortgage against it, a reverse mortgage with no mortgage payment. They're still responsible for their obligations of the taxes and insurance, but now they've bought a $200,000 home with just $100,000 out of pocket, and again with no monthly mortgage payment.
What does that? So Doug, touch on that real fast. What does that look like from an operational standpoint? Getting that person qualified. I mean, is it the same as a reverse mortgage? Or are they going through exactly what we know, the processing, underwriting, closing? Are they going through everything just as a forward would?
Yeah, it's a very similar process. I mean, the reverse mortgage as a whole, whether it's a refinance or for a purchase, there's still the same process of taking the application, the appraisal, processing, underwriting, etc. There are a couple extra parameters when you get into the HECM for purchase. There can be a potential DTI ratio requirement if they're retaining other real estate. So if they're not buying contingent, so to speak, then there may be a DTI ratio, and they still have to meet this financial assessment portion, the income and credit side. So as I said, every loan is a little bit more unique, but there is a criteria they have to approve for. And again, it's the same formula as far as the way we determine what's available from the reverse. It's going to be based on the home's value and their age. So again, a 62-year-old or an 82-year-old are going to get access at different amounts of money.
Cool. So that's how to use a reverse mortgage to buy a home.
Correct.
Okay. And I think you said before, non-recourse loan, correct? Lords asks.
Correct. Non-recourse.
All right. But what if they are buying a house for $100K, but is appraised at $200K? Would there still be a down payment?
Yes, we still go based on sale price or appraised value. Yeah, we still use the traditional whatever's lower.
Cheryl's paying attention. She has good questions for you. All right. Feel free to ask more questions, guys. So we talked about product information, basic borrower qualifications, compensation models. Was there anything else on compensation you want to share with your loan officers that work for Finance of America, how they're going to earn money, helping people get involved with the loan?
Well, I think first and foremost, it's, to do this, to be able to do it either way you want. If you want to be like Cheryl and learn every aspect of this product to go and do it and write that reverse mortgage, we're able to help you. Doug is here at all times to answer any questions. And we will be sending an email out with Doug's information, and we'll actually have it on this YouTube as well. And Doug, correct me if I'm wrong. I mean, we have Finance of America Reverse has all of the marketing material we need, right? They're willing to help us with any type of seminar we'd like to do for, the baby boomer or the retiree. Is that correct?
That's correct. We're willing to, actually help in that webinar or seminar if the branch would like that. We provide all of the marketing, the presentation material. It's all catered towards, whether you're presenting to a realtor, to a financial planner, it's already there, ready to be customized with your borrower or with your specific information.
So what we talked about earlier, Doug, I read that article and I told you that, there was 76 million baby boomers. Mm-hmm. And we all know baby boomers are getting ready to retire. Obviously, not all are 62 or older, but a majority of them are. I would probably say more than 60% of that 76 million are. 30% of those 76 million people have no retirement. I believe it's 20%, have less than $50,000. So this product is going to be more and more in demand as we go on. And I think the more proactive we are about this product, and getting that information out there, and that you can use it for a purchase, that you can use it to help offset costs for home care for the elderly. The more that we go out there and sell it is, the better off we are. And we're one of 2 companies, as Doug said earlier, in the country that has even this jumbo product. Now, people in, Wisconsin may not be able to offer that, but people in California can, right? People in Florida may be able to. Doug, are we able to use this for condos?
Yes, they still have to be FHA approved.
So it has to be an FHA approved condo. How about manufactured home?
Manufactured homes is okay.
Manufactured homes are okay. Okay, so it can be anything.
Correct. And I like to piggyback, Jay, on what you were saying about the senior population. And what's really interesting to me is now is really the time to go in and attack this, because I've been doing this for 11 years. And, my client 11 years ago typically was in their late 70s, early 80s, was more depression mentality, very hesitant to take out a mortgage against their home because they owned it free and clear. Today's senior, we're dealing more with, as you said, the baby boomers in their 60s. They get financed. They're not afraid to leverage their home. So there's a tremendous opportunity right now to go attack that. And, you stated the senior population numbers. Last year, as a nation, we've only done about 54,000 reverse mortgages. So, I mean, it's in its infancy.
It's not even 1%. We're not even scratching the surface. And millennials, we always hear everyone talk about the millennials nowadays. And millennials are about 80 million. So just to put it in perspective, we're going to put so much time and effort into the millennial, and they represent the same amount of the population that the baby boomers are going to represent. So, there's opportunity from both angles. I'm not taking away from the millennials and that we shouldn't be attacking that. But, I do want to focus that there is another avenue or another stream of income that we can use. And I do want to be proactive about that. I want us to be forward thinking and jump on this because it's a great opportunity. And, you have somebody like Doug that is able to walk you through the process, that understands it from start to finish. And by the way, you can get paid and make some solid money on it, right? Doug, I think that's probably the most important thing. And let's touch on the compensation real fast, because there are a few things, and that
I have a referral program too. We talked about a referral program.
Yeah, the referral program. But what I wanted to touch on, because it's very important with this compensation, you're only paid on the draw amount. Okay, so that's really different. And Doug, I want you to touch on that, because some people think, oh well, I did a $500,000 reverse and I'm getting paid on a $500,000 reverse, but that may not be your draw amount. The initial draw amount is all you're getting paid on. So if you can, Doug, just touch on that really fast.
Sure, be happy to. So right now, let's just use the example that loans are paying. I'm picking a middle ground here, 8-10 points on the back end. So that money is being paid on the draw at closing. So let's use a scenario of a $400,000 home value, and what we say principal limit or loan amount of 210. You're not getting paid on 210. You're getting paid on what of that 210 the borrower is using at closing. Are they paying off a mortgage of $20,000? Are they paying off a mortgage of $150,000? That's going to grossly change the amount of revenue on these loans. So, again, every loan is going to be unique to that, but you can see doing the math, 8-10 points on 20 grand versus 150 grand, the revenue stream really changes.
Yeah. So if we had an example, most of our seniors are going to have, they're going to be mortgage free. I'm assuming.
I'd say average you're seeing probably draws between 40 and 60% at closing is what you're average seeing, between usually paying off some sort of small mortgage, a home equity line of credit, and they're looking to get access to a little bit of cash.
How many of the reverse mortgages that we are doing or that you have done, how many of those actually were we paying off an old mortgage? What would you say percentage wise?
Majority of them today have some sort of mortgage balance.
Have some type of mortgage balance.
So 10 years ago, 10 years ago, there was more commonly no mortgage. Today, they usually have some sort of mortgage or obligation.
But to put it in layman's terms, if someone had a home free and clear and they wanted to do $100,000, reverse mortgage, the line of credit style, and their initial draw is 20,000, they're getting paid off of that 20,000, correct? Not off of 100,000.
Correct.
That's just important for everyone to know how they work and how they get paid, because I don't want people going out and selling a reverse mortgage and being excited about a $500,000 loan when there was only a $50,000 draw. Take it from there. So that can change pretty quick.
I want to address one more thing we promised people. Just about 4 or 5 minutes here on just how to network with realtors. For the what's HECM stand for?
HECM is HECM, home equity conversion mortgage. That's just the fancy term for government insured reverse mortgage.
Got it. Okay. So we also strategize on how to network with realtors using HECM for purchase, which allows a senior to buy a home using a reverse mortgage. So how do you network with realtors for that? Let's take 5 minutes of that and we'll conclude.
Our sister company, actually, interesting enough, they have educational material that's actually, I believe, I'm 99% sure, I was told that that's they're CE approved. So continuing education for realtors is a great opportunity to get in front of them, educate them. They have to do their continuing it anyway. So it's a great way to get into their offices, do a presentation on how they can generate more business for themselves. And obviously there's a benefit to you as the mortgage loan officer as well in doing the deal for them.
Sure.
It's another tool. I mean, the key is, we did talk on this, but this is another tool for our salespeople to go out and go to their referral sources and give them another angle. This brings another buyer to that home, their listing, right? This brings another buyer to that quaint neighborhood that has the $400,000 house, and they may want to upgrade. We may have a couple that has a $200,000 home that's free and clear, and they want to sell it and move into this house. That now creates a larger buyer pool, and that's important to know. There's so many different ways to market this to our referral partners. And I think what we need to do is get the marketing material, set up these seminars, set up a webinar. Doug will be more than happy to jump on and answer any questions that you may have or any of your referral partners may have. Utilize this. This is a great asset, a great tool, a great resource to have. So if you want to learn anything more about this product, my information's on here. If you want to learn about joining Finance America to have this product, my information is going to be below on this video here. Doug's information is there. You can reach out to me immediately if you want to get in contact with Doug as well. We'll be more than happy to set up anything and get you guys started in this program. So, Frank, I don't know if there's any other questions. Doug, if there's anything else you want to touch on.
One more question. Can they use the money to buy investment property?
Yes, they can. Yeah, there's limitations to how much lump sum cash the borrower can take at closing, but yes, they can take a large portion of it, and it's really to use at their discretion. So if they want to buy real estate, certainly allowable.
Cool, Evan. Well, we'll go ahead and conclude there. About 30 minutes. Hope you enjoyed the video on how a reverse mortgage works. We have more of these planned. They'll be very nice, educational, quick, to the point, so you guys get the knowledge you need. And Brian says, nice job, Doug. Brian Cooper.
Thanks, Brian.
Hey, guys.